I think we're going to see a financial reset. Dollar's going to skyrocket. Gold and metals and miners and everything is going to pull back and sell off, including real estate. And then there's going to be a bottom, and probably see the precious metal space bottom probably months before the stock market. It's actually a really good warning indicator to get a feeling that the once gold and precious metals start to move up, that means like the forced liquidation, the major downdraft is that selling pressure is alleviated.
Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com, returns once again before the end of the year to recap what happened in 2023 with the markets, what's currently happening now, and give us his outlook for 2024. What will be the best and perhaps worst assets of next year, according to Chris? Let's find out. But first, a shout out to our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space. It also has unique tax benefits for investors. So if you're thinking about where to park your Bitcoin profits for this year, think about an IRA like iTrust. If you're over 18, you want to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below to learn more and get started. Chris, welcome back to the show. I know you're going away on vacation soon, so thanks for making the time before you leave on your trip to give us your outlook.
Yeah, thanks for having me, David. Always a pleasure.
The S&P 500 looks like it's ending the year strong. We'll talk about that and some of the other asset classes that you follow, including oil and gold and some other commodities. And we'll get your end of year prediction for 2024 for the best and perhaps worst assets of the following year. But Chris, let's talk about what's going on right now. So the S&P is currently at 4,600 points. It actually is ending the year on, well, it looks like currently it's on track to end the year on a 1-year high. And unless something, well, not exactly 1-year high, but a 2023 high.
Yep.
Unless something dramatically bad happens in the next 2 weeks, the last 2 weeks of the year. What do you think this is going to happen? Do you think we'll get new high? I think you talked about this, that we'll potentially get a Santa Claus rally before the end of the year. It looks like it's happening exactly the way you said it would play out.
Yeah, I mean, when we look at the SP 500, we just recently broke the July highs. The market has had a very strong push to the upside, and really the next resistance level for that is going to be the highs that we saw back here in 2022. So we're really close to, we're in striking distance. Seasonality wise, we are primed and ready for this market to continue to push higher into the end of the year. It's been a high momentum move, and these strong rallies and little pauses that only last a few days or a week or so. The fact that we just keep kicking back into another bull phase is telling us that this market has got quite a bit of power behind it in terms of its short-term momentum. And a really good view of this is actually the seasonality chart of the SP 500. If you just look at this full year of how the SP 500's moved over the past 30 years, we got a rally up from the beginning of the year. It tops out in June, July, sells off into October, and then we have a multi-wave rally into the end of the year. So if we just look at the SP 500 and we just look at this year's price, we can see we've done the similar type of price action. We rallied up, we topped out in July, the market's rolled over to the end of October, and now we've had this multi-push to the upside, and it is pointing to one final push, which again, if we just look on the right edge here, we're just starting this rally into the very end of the year. So I think we're starting to see a lot of shorts starting to cover. People are starting to get very bullish on the markets. And if the stock market can break to nominal new highs, even by one tick, we're going to see a flood of short covering, meaning institutions and traders that are betting on falling prices are going to have to get out of their short positions. It's going to cause a feeding frenzy of automated buying. We just saw this in the gold market. You and I will be able to touch on that in a minute. So you'll see exactly what I mean. This could happen for the SP 500, where it pops above here and suddenly, billions of dollars gets covered and it has to buy back shares because they do not want to be short this market. Plus, there's going to be a whole new boat of investors who literally can't take it anymore, saying, I got to get back into this market. It's hitting new highs. It'll be, headline media everywhere. Stock market hitting new all-time highs. We're back into a bull market phase, and that'll suck in. That'll be like the ultimate FOMO catcher. It'll get everybody moving and jumping in. And then the big question is what happens to the market? Do we see big institutional selling, high volume selling, which I believe we will if that happens. But it's going to be really interesting. So I think we still have a pretty strong, or I think the market's going to hold up into the end of the year.
So, Chris, can we just go back to your seasonality chart one more time? I'd like to learn a little bit more about this chart and how it works. From a charter's perspective, how do you interpret data like this? If you look at how a certain asset, in this case, the S&P 500, has performed in the past, do you go with what history has done in the past, or do you trade against it, meaning you're more contrarian?
Ooh, that is a good question. I think that comes down to your personality type, but I put it this way. I do not trade based off this. All I look at the seasonality is really just for, do we have a tailwind behind us supporting our position? Or do we have a headwind? Are we really long the market and it wants to naturally go the opposite direction? It's really just something to look at. It's just interesting. It's a comfort thing. I don't trade off this. I have in the past tried to trade it, and sometimes it works, sometimes it doesn't. This does not mean the market moves like this. Markets are definitely not that easy or simple. So I wouldn't use it to trade. It really is just to, like, when something's playing out just like it has, you might as well keep following that in terms of as a kind of mental support and strategy support, just to be like, okay, this should carry through. And, if you've got headwinds and maybe you want to be a little more defensive, you want to be more protective in a position you have, or tighten up profits if you've had a good run or something like that. So it's definitely not something I would try to pick a top or bottom and try to dance around. The markets just don't move that easily.
Do we have an explanation as to why, or a theory as to why the S&P has performed historically very well in the last quarter?
I honestly don't know. Like, I would just think mindset wise, I mean, in terms of, marketing wise, you see this all the time. Usually January comes around and everybody is now re-energized to go and buy and reinvest and buy products and do things they want to do. And they usually do that into the spring, right into May. And then usually we go into the summer doldrums. Everybody's kind of done and bought what they wanted. They're set for the year. And then eventually fall comes around, seasonal change. And if you haven't done well or you're struggling or whatever, a lot of people just, they do one last push for the last final quarter when it comes to investing. And we see money pile back in, and they try to perform and reinvest. I don't know what the real mindset is. That's just the way I kind of see overall kind of mentality of people, like in the January to the May window. And then October is always that, like, last push, last quarter push, of
Maybe it
whether it's
has to
health or finance. Yeah.
Maybe it has to do with taxes. The tax season coming up, people want to liquidate the trades after they file their taxes. Could that be it?
Yeah, for sure. I mean, yeah, I don't know if anybody really knows the answer, but
Yeah,
taxes are a big chunk, so they
right.
they definitely could play a role in that.
Well, that's a good chart to at least just keep in mind as a trader. So looking forward then, Chris, you were saying how if we have a break above a certain level, we could see massive short covering and a feeding frenzy. Can you walk us through one more time what that level is?
Yeah, so more or less, I think the breakout level will be on the SP 500, somewhere around that 4,800 mark,
Hmm.
which is the high that we saw back in 2022. So I think that's going to be a real big trigger for orders to get shorts to get stopped out, for new long positions to get entered. And it's a whole number, 4,800. There's these whole numbers that are really important. Typically, people don't say I'm going to buy at $471. They say I'll buy it if it breaks 4,800, or I'll buy it if
Right.
it breaks 900, or vice versa if price is above something. So these whole numbers, when price lines up with those, that it adds an extra level of strength as resistance if you're under it. But when you break it, it also creates a lot more power because it's got a lot of people also equally offside now.
Let's recap the year before we move on to next year. Anything in particular surprised you with how the markets behaved throughout 2023?
I think the big surprise has been the AI. I mean, I kind of got hooked into the AI in December of last year, and it feels like that has really saved the major stock market indexes, and it's done a lot of heavy lifting. When we look at the overall markets, it has been a very, very strong year for the large tech companies. But the reality is, if we look at the overall stock market, which the Russell 2000 is a very good gauge of this. I mean, the Russell 2000 broke down, and now it has been really just trading in this giant range. And this is how most stocks are. The stock market's not really, or what I shouldn't say, most stocks are not trading up near the highs. Most stocks are sold off and they're really just treading water in this giant complacency, kind of people hoping the market is going to go higher. But really, most stocks are in a very bearish pattern and they're pointing to a huge sell off down the road. And a perfect example of this is actually the ARK K ETF. This did the full life cycle of a bullish phase, a blow off top, a consolidation. It's broken down and it's in a consolidation and it's just near the upper end of the range, like the small caps. I believe we're going to see, the ARK ETFs down in the teens. It's like $16 for this potentially if the stock market goes into a bigger correction next year. So, the markets to me most stocks are underperforming like this, nowhere near the highs. And a lot of people don't realize that. It's really just, a handful of big techs. Semiconductors are hitting all time highs. We've got the tech sector hitting all time highs. They're the ones doing all the lifting. The rest of the stocks in most people's portfolios, who are spread out over a bunch of random stocks, are suffering and not really performing that well. Actually, yeah. So that's kind of my outlook of what's going forward. I think
Yeah.
it's going to be difficult ahead.
Well, I think ARC in particular is an example of a micro issue as well because that ETF, I'm just looking at the fact sheet, it has a lot of stocks that did really, really poorly in the last year or so, like Zoom, for example, Roku,
Yeah.
Coinbase took a big hit. It didn't, Kathy Wood isn't actually heavily invested in any of the AI stocks, at least not in her top 10 holdings. She missed out on Nvidia. She missed out on a lot of things. The big tech companies that went up a lot this year, that's gone. She's in Roblox, which got hammered. Anyway, so ARK is just, yeah, it didn't do well. But yeah, you have a good point. Overall, the index looks like it's trailing, in precarious territory. Well, let's talk about that. You were telling me last time and several times before that as well that once we see a blow off top, we could see another retracement by potentially the order of 50%. I'm talking about the overall S&P 500 index. Is that a sentiment you still have, Chris?
Yeah, I think it's very possible. We take a look at the monthly chart. I think a thing to look at here is the stage analysis. I believe we're in this stage three topping phase. We're in this complacency mode. The market's kind of going up, trying to do another double top here, but eventually we're going to go into a stage four decline, which is like a 2000 tech bubble burst. It's the financial crisis. It's a financial reset across the board for pretty much every asset class. So if we were to take a look at of the markets here, here's the SP 500. If we go back and look at these other major previous peaks, we saw the market come up. It made a high. It made a double top. And then eventually it broke down into a multi-year correction. This was the tech bear market. And we saw it very similar in 2007. We saw a rally up. We saw a big sell-off. We saw a double top where it actually came up and just pierced, which is what I'm talking about, could happen again this time. It sucks everyone in who's not long, thinking this is off to the moon. And then it rolls over and dies and goes into a huge correction. So these are all double top phases. Now, these were fairly close together. We got a lot more manipulation, a lot more going on with the Feds, but we are coming up to a major double top, potentially a pierce of all-time highs. And then we just need to see how the market reacts. What does the big money do? Do we see big volume step in and then potentially go into this stage four decline, which if we zoom back on the charts, we could see this potentially drop.
So
Sorry, go ahead.
that's the S&P 500. I'm curious as to whether or not you think the same analysis can be applied to the Russell 2000 or any of the smaller cap or mid cap indices, because we're not seeing a double top pattern exactly like the S&P with the Russell, right? And so I don't know what you think about that. Is
Yeah.
that a safer bet in your opinion, or do you think it's just the same thing on a different scale? What's your take on the Russell in relation to double tops?
Right. Yeah. So long story short is the double top here in the SP 500 has got a lot of power. You can usually just take the topping pattern, you can stick it to the downside,
Yeah.
and we can get an idea of kind of, we're looking at 50%, just based on like the most basic analysis. But that analysis does work very well, believe it or not.
Mhm.
If we look at the Russell is doing exactly what I showed on this chart right here. It's really just it's struggling to go up. It's actually in this complacency sideways stage, and it's kind of underperforming. It's a dog, meaning when the market breaks down, it's actually going to sell off even more because nobody already wants to buy it. So when the selling pressure hits, there's no one there to swoop up and want to take on these high risk stocks. So they drop really, really fast. So to me, this is a more bearish picture, or equally bearish actually, as a double top. They're just different patterns, but they both point to dramatically lower pricing.
So are you biased towards the large caps or small caps right now?
We are long. We're along the large caps. Yeah. And we're even along the ARK ETF, believe it or not. They're all on a tear right now. So market's up. We're trading following that trend. But my long-term view is bearish. And that's the big disconnect that a lot of people don't fully understand. I may sound really bearish, which I do sound bearish, but I don't trade just because I think something's going to happen. The markets have been going up all year. We're long, we're riding this out, and we're taking advantage of it. But when it rolls over, you won't catch us holding stocks that are falling. We'll move to something to profit from that. So you got to just people need to make sure opinion is different than actual open positions of what we're doing. They can, be the opposite at times.
Have you ever considered, well, you definitely have considered this. Why don't you perhaps hedge yourself on a longer term basis? Let's say you're long short term, but if you're bearish long term, maybe have some long dated put options. I don't know. Is that something is that congruent with your style?
No, yeah, I don't do that style. I believe hedging is it's just expensive.
Mm,
It's got all kinds of costs to it. And if your hedge works, it's only going to hedge a portion of your account. You're still going to take a hit. And then you had to also pay for that hedge. If it doesn't work out, then you just threw all the hedge money out the window. I'd much rather just say, hey, if it's in a strong uptrend, we're hopping in, we're riding it higher. If it shows signs that it's rolling over, we're going to get out, find something different. Um, I'd rather just move aside, and instead of hedging, I'd rather jump into something that is, starting a new rally and screaming higher. So I'm all against kind of hedging. If you think it's not going to work out and the trend shows that, don't hold it. Just move to something else. I do not fall in love with positions at all. That's one thing that a lot of people struggle with, is they're like, oh, I've owned it forever, or I love this. And that's not how you trade. You don't, the markets really don't care what you think or feel. So you just think of it as like renting stocks and renting a position. And all you want to do is catch the upside or the
yeah.
downside, depending what side you're betting on.
Is there a reason you like the large caps more than the small caps right now?
Well, they're more liquid, and they have, I find, nicer trends to trade. So I
Mhm.
really just find the large caps are kind of the play if you're moving around large amounts of money. Um, and I mean, I have a lot of followers that we do, so we stick to the most liquid things. And I like things that move slower. You and I have talked about this many times. I look at the stock market like a tide. Either the tide is going up, it's lifting all boats, a bull market, stocks are
Mhm.
going up,
Yeah.
or the tide's going down and stocks are going down. So I just like to catch the tide. I find the tide is much cleaner with large caps than it is with little stocks that are all over the place.
Before I move on to commodities and the dollar, I want to throw this question out at you. I heard this asked to somebody else. Somebody brought this to my attention. If I gave you $1 billion, hypothetically, in debt, you have to pay it back, but it's interest free. First of all, would you take this? Second, what would you do with it?
How long do I get to keep it?
That's a good question. The debt matures in, let's say, 5 years.
Oh, that's a tough one. I believe real estate's going to be a huge buy, but it might not be really good for another 2 or 3 years potentially, which doesn't leave a whole lot of upside and
But
time
but but
after
remember
that.
now, Chris, you're $1 billion in debt. You got to pay it back in the next 5 years. So whatever you do, you better make sure you have $1 billion left by the end of 5 years.
Yeah, well, I think I would definitely take advantage of. I hopefully the market rolls over and I take advantage of a collapsing market. Stocks
Okay.
fall 5 to 7 times faster than they rise, so we can make a fortune on the way down with inverse ETFs. Um, and then there's going to be commodities that come to life. Like I think the precious metal space is going to be one of those we haven't seen since like beginning of 2009 or 2002. where they're going to go up hundreds or thousands or tens of thousands of percent. So we're not quite there yet, but we're probably within the year window of that becoming a way to make a ton of money. So I think that whole space is going to be falling stock market is one way to profit. And then we have to shift gears into leading sectors back into the stock market because I do think it'll rebound and recover to some regard. And then eventually move into real estate. And yeah, 5-year window, it's not a huge window, but within that 5 years, you got a falling market, and we're going to probably see commodities go through the roof again, like commodity stocks. So there's kind of a couple plays there.
Yeah. You are you are a lot more risk on than I thought you would be. I would have just said, look, I'm gonna put it into some treasuries or CDs, get my 5% on that. What's 5% in $1 billion? Like $50 million a year?
That's a
And
lot.
just and just retire. I'll give you back the $1 billion in 5 years, but I'll make 50 million a year just on interest. But I like your approach. It's more exciting. Okay. So on that note, let's roll into the gold sector. Gold has or it's seen a tremendous performance over the last month, really, but it was really peculiar what happened a couple weeks ago on a Sunday night. Remember that when
Mhm.
it spiked up to new all-time highs and then it came crashing back down? Can you just walk through from a chartist perspective what happened there?
Sure. So there's a few layers we can peel back kind of this chart. The first one is this is the monthly chart. We have the all-time high up here around that 2089, somewhere in that area, which is that level we broke uh, outside regular trading hours. So we had this huge pop, and I think that was a lot of short automated trading, orders getting filled that were placed. So anybody short gold betting on lower pricing would have got squeezed out. The market's going to find a way to try and get you out. So that creates buying pressure. Plus, there's so many people following gold and just want gold to go higher that they have orders out there saying if gold hits a new all-time high, I got an order set there to put me in and get me long. And so we can see this actually really, really well on the 10-minute chart. Here is the 10-minute chart. And if we actually just zoom in, we can see what happened here, which is this blue line is the all-time high.
Hmm.
And as soon as it got triggered, all the shorts got squeezed out. All the people saying, I'm going to buy gold when it hits a new high got piled in. When we get a crowded play like that, everybody does the same thing at the same time. Typically, it's a turning point. And so the market has gone the exact opposite way. Gold has sold off pretty substantially from those levels.
Mm-hmm.
I mean, this move in gold, we haven't seen a move like that in a long time, down like 7-8% in a very short window. And so to me, this move is more so the stops getting run. It's a technical shakeout or fake out, whatever you want to call it. Because if we look at the regular trading hour charts and we go to GLD, like how gold moved during just regular trading hours, meaning 9:30 in the morning Eastern time to 4 o'clock, gold never broke out. We got this high right up here. Gold isn't actually making new all-time highs from when the masses actually traded and see it. So that is not a very good sign. The futures chart of gold is a very bearish one in terms of multiple time frames. This monthly chart, if it closes like this, is pointing to many, many more down months, usually 2 or 3 minimum. The weekly chart is pretty bearish as well. It is a big reversal pointing to several weeks to the downside. And the whole precious metals space, we just don't have gold miners participating or gold at all. They're all just floundering, selling off. Let me just go to the daily chart just so we're looking at a closer time frame. But when we look at gold miners, I mean, they've just been chopping around, trading lower. They came to life for a little bit and they're selling off. Silver miners are the same, and silver itself is kind of doing the same thing. It's just been trading in a really gnarly range. It came to life a little bit and sold off. The big thing that really stands out here is simply none of these leverage plays on the precious metal space are actually really participating. Gold is up here, which means silver should be up here, and gold miners should probably be way the heck higher. But gold miners and silver are down like 50%. So this is not a broad market precious metal space rally. People aren't piling into this. The whole miners and precious metal space kind of built this support level. It built a bottom. It's now built this launch pad, and it's just waiting for the right time. If the market doesn't shake you out, it will wait you out. And this is what the gold market has been doing forever. And we're getting closer to this type of move. So there's going to be a time when we see silver skyrocket and hit probably all-time highs. Miners will skyrocket, but I still think we have more time before all that unfolds.
Well, the miners, I understand. Maybe it's being held back because of rising costs and inflation, or management issues, all sorts of industry-related issues. But the silver one is, from a charting perspective, interesting. Like you mentioned, gold is at an all-time high, silver not anywhere close. When you look at that divergence between the two metals that have historically moved in tandem, do you think to yourself, I should long silver or short gold or neither?
I'm naturally long both. I like owning both physical, long term kind of
But just on
play,
a
kind of.
like a pair trade basis, if I were to ask you to do something with gold and silver only, would you long both? Would you short one and long the other? Would you short both? Yeah, relative to each other, how do they perform in your eyes?
Yeah, I would probably lean towards silver just because
Mm.
it's, undervalued. It's gonna have one of these rocket ship moves. I mean, we've seen it happen many times in the past. So silver, I mean, gold's already up at all-time highs. I mean, it's not a very big percentage mover, but silver has these spikes, these massive launches. And the reality is, my reality or my opinion, I believe where we are right here for gold, silver, and miners is almost exactly where we are right here after the major bottom in early 2000s, the start of the next major super cycle for commodities or for precious metals. So we just have to let this mature out. The big question is, are we going to see gold and silver rally up a little bit until we have a financial crisis? So are we going to see it maybe push up a little bit for a few more months, and then when we have a crisis, it gets pulled back temporarily and then take off? Or is it going to just continue to chop here until the crisis is more or less almost over, and then finally we start to see this spike up? So I believe we're very early in this brand new cycle. Literally, this is like the first step of many bull flags, many steps higher. So, I mean, this is really exciting stuff. It's just we have to be patient. You look at this chart, it goes back to the 80s. So
Hmm.
these patterns take years to unfold, and we've waited since 2011. It's 12 years of um,
Yeah.
patiently, painfully waiting for the next, like, I used to call them golden rocket ships. We get in these things and they
Yeah.
just skyrocket. It's unbelievable, the
Well,
power in gold miners.
let's move on to oil, and then I want to wrap up with your outlook for best assets. Oil has taken a huge hit the second half of the year. Um, is that something that you still or favor at all right now, given how much it's dropped from its highs early in the year?
Yeah, so I'm pretty bearish on oil. I mean, we got a pretty major pivot point on the chart. I believe we're going to see this. It might chop around here for a while, but overall, I think over the next 6-12 months, I think it's going to be under pressure, trading lower. I don't see it skyrocketing up. I think we're more things are slowing. I think oil sees that, and if we get selling in the market, it's going to pull things down. So I'm pretty bearish. It is trading right at a major support level, so it is just holding its ground across this very critical pivot zone. So right now, short term at support, but overall, I mean, it's just got selling pressure, and I think it's got headwinds to really muscle itself higher. It's most
Hmm.
likely going to drift down.
Okay. And finally, let's touch on the US dollar. You were telling me last time you really like the dollar. So let's look at the technicals there. The dollar again, big moves this year in conjunction with the 10-year. How's it looking right now for you?
Yeah, I'm still very bullish on the dollar. I think typically when we have major catastrophes, major financial resets, we see the dollar become that safe haven play. Although most people don't trust the dollar, they don't like the dollar. Everybody says the dollar is going to collapse. The reality is when all hell breaks loose, the dollar rips to the upside. We saw the same in 2008, and we saw the same coming out of COVID. And I think we're going to see another crisis in the market, and we're going to go back up potentially somewhere similar to the 2000, which is
Mm,
going to coincide with very similar price patterns we saw on the gold chart, where the stock market sold off. Gold and silver miners eventually found this major bottom because the dollar found a major top. And then we saw the dollar sell off for like 10 years. So we could get back up here. And if the dollar sells off for 5 or 10 years, that is quite a long time for gold stocks to rally. And that's the scenario that I feel is setting up again in terms of commodities and everything's valuations being at like crazy levels, and commodity prices actually being very low in general. They're super undervalued. So we just need to let this kind of financial shakeup take
Yeah.
place. And then I think we're going to see the commodity space do very well.
What happened in 2008 and 2009 for gold and the dollar? I ask this because you're right. When there's fear in the markets, when there's a catastrophe, people flood to safe haven assets like the dollar. But then the dollar and the gold price are usually inversely correlated. If the dollar moves up, gold usually goes down. But that's in a normal market environment. I'm wondering what they do when there's massive fear. Do they both move up at the same time?
They no, they gold goes the opposite direction. Simply, even though there will be money flowing into gold because people are scared and they just want to go to a physical asset, the problem is when the stock market starts to sell off, most people don't have control. Most people are over leveraged in their account. They're always using margin and leverage ETFs, and they get margin calls when they didn't even realize they were close to them, and it creates forced liquidation. And of course, the brokers just start liquidating. So there's going to be margin calls, and it doesn't matter what's in their account. The brokers just start selling. So there's going to be natural pressure just from people not knowing how to manage money or their portfolio. And there's naturally, when people just get scared, they're like, just sell everything. People will hit that level where they'll call their broker or open up their account and just start closing everything out, saying, I can't take it anymore. I'm moving inside, forgetting about the market for a while. And of course, the dollar going up also puts pressure on this. So there's just a natural wave. So the stock market almost always has money flowing into it. There's always like monthly, weekly paychecks, biweekly, quarterly, monthly, all that stuff. There's always money trickling in. And that's why light volume favors a higher stock market. It's the same with a lot of things like precious metals, like gold. People are constantly trickling in and buying some. It takes high volume to drive price down because you need more volume than the typical daily volume, which is always on a positive kind of bias. And so when we hit a bear market, the whole thing flips. There's money coming out every month because people need to borrow it. They need to use it. They want to protect it and stop it from losing. So it's just liquidation starts coming out of assets and it pulls everything down. Silver and gold, gold pulled back 34%. Silver had a much bigger pullback. If we look at that pullback here, that was, I think it was like a 60% or something. Yeah, it was like 50+% pullback in silver. So they're volatile. They get hit. It's short-lived, and they, should rally and find a bottom before the actual stock market does itself. But during the main downward spiral of blood in the streets, of everybody liquidating, they just get sucked down really quickly.
What happened with the dollar in 2008?
The dollar, it skyrocketed up. People liquidating, people wanting to get somewhere strong. So the dollar
Got it.
posted this huge
Okay.
rally and
So
skyrocketed 25% in value, which is why gold and silver just crashed.
yeah.
That's a very big percentage move for a currency in a short window.
So that leads me to my ultimate question. You said that, like you pointed out with evidence, when there's a huge financial crisis, that's what happens with the dollar. And we talked about what happens with gold. Can you make a case then for a big financial reset, your words, for next year or perhaps 2025? Is that something that's possible for you?
I think that's going to happen. I think we're going to see a financial reset. Dollar's going to skyrocket. Gold and metals and miners and everything is going to pull back and sell off, including real estate. And then there's going to be a bottom, and probably see the precious metal space bottom probably months before the stock market. It's actually a really good warning indicator to get a feeling that the once gold and precious metals start to move up, that means like the forced liquidation, the major downdraft, is that selling pressure is alleviated. And so that's like an early warning sign that the stock market now, it isn't just overrun with selling. It's actually now a little bit kind of running out of momentum. So yeah, I think rising dollar, falling gold, falling stock market, and then hopefully it'd be amazing if it all happened in one foul year and then the market bottoms and takes off. But this correction could take many years overall for the stock market to recover. We'll just have to see.
Okay. So that answers my next question about your preferred and least preferred assets for 2024. Good summary, Chris. Your trading methodology, I like everybody to click on the link down below and visit Chris's website where you'll learn more. But give us a teaser. I mean, here on our show, we talk about your outlook a little bit about your methodology, but I think people will learn more from you, right? If they go to your website. But tell us what they'll learn from you exactly.
Yeah. So if you go to my website, we've got lots of videos on our blog that talk about it. But long story short, I focus on asset revesting, which is a new term that I put to a strategy that I use. It's I wrote a book about it, which you could pick up if you're interested in learning about it. So there's high level, there's buy and hold investing. You ride the roller coaster. You really don't have much control over your downside or anything. And then you've got active trading, which is fairly dangerous for most people to do. Well, asset revesting is kind of right in the middle. Those two are the extremes. This is like, let's find nice, strong trends in large caps or the indexes or currencies. Let's move into those trends, ride them. And when those high momentum trends start to lose steam, we rotate out of them. I focus on just trading ETFs, and we only hold assets going up in value. So if nothing's going up, we'll sit into a BIL, which is a cash ETF, pays us daily dividends while we wait for a new opportunity. And we just kind of rotate through the markets, trading low volatility ETFs like the indexes, bonds, the dollar index ETF. And it's pretty educational. I do videos just like what you and I are doing right now, David. I walk people through the markets. I explain what could happen, both scenarios, how we're positioned, how it'll affect us. And it really takes a lot of stress out of the markets because we're not trading a whole bunch of different things. We're in one asset class at a time, rather long stocks or bonds or a currency, or we're waiting on the sidelines, just earning interest. We don't have a diversified portfolio because if you got a bunch of stuff doing really well, but you hold a bunch of stuff doing poorly, you end up with a roller coaster ride, but poor average returns. So I'm all about pick that one asset class that's moving, move into it, own it, get out of it when it shows signs of weakness. You're literally just renting the asset to gain some value and then step aside and go rent something else.
And if all this goes away, all this trading stuff goes away, you're going to be a movie producer, right? That's what.
Yes. I'll be one no matter what. We're working on producing a movie called The Goldilocks Mission.
Okay. Yeah, you're raising some money for that. Congratulations. Congratulations. I think you met your target. Well, tell us a little bit more about this film and where we can eventually watch it.
Sure. Yeah. So the Goldilocks Mission, it is a sci-fi action adventure kind of teen hero movie where it's all about learning about climate change and the newest technologies that Earth has that people don't even know. We've got some of the most incredible products and tools and systems and services that allow us to do so many cool things that are good and green for the environment. So this is a little bit around climate change to educate the world about how we can all do our part. But this will eventually, we're working with scientists from all around the world, astronauts, experts in the clean tech field. But this is going to be hopefully on the mainstream. We've worked with Netflix, AMC, Prime, all kinds of different smaller outlets as well. So eventually this movie will come out and be available there. And so like right now we're in the cool stage where I'm actually 3D printing some props from a carbon capture company out of Alberta, Canada here. And it's amazing. They can capture carbon before it gets off gas from a energy plant. And we can reuse that carbon and put it to use for products. So we're stopping it from going in the air. And now we're making props for a movie. And it is pretty amazing the technology that's out there. So it's exciting. And we're looking for new products to put in the movie as a product placement. People with cool technology, with green angled, products that help the planet. So that's what we're focusing on right now to really present entrepreneurs around the world and show the technologies and products that are available for kids and for everybody to use.
Chris, thank you once again for being on the show, and thank you for participating on the show throughout this year. I wish you and your family a happy holiday season. Enjoy your time off, and we'll catch up again in the new year.
Hey, thanks, David. Always a pleasure. And everybody have a great holiday and New Year's.
Thank you. And happy holidays to everybody watching. Thank you for being here, and thank you for tuning into our show. Make sure to subscribe, like this video, and follow Chris in the links down below.